Brooke Lively discovered her passion for helping entrepreneurial firms by working with her father. After getting her MBA in corporate finance and investments at Texas Christian University and a quick stint at a hedge fund, she found herself helping her family establish a new business, which hit the seven-figure mark within 18 months. Soon after, she started talking to other owners who asked, "Can you do this, what you did for your family, for us?" This is when Brooke realized that most entrepreneurs don't run their firms by the numbers. They're making decisions based upon their gut, and that caused a lot of anxiety, not to mention a loss of profitability. With that insight, Brooke started CAFCAP, a fractional CFO company designed to maximize profitability. Since 2013, Brooke and her team have helped hundreds of firms make data-driven decisions to drive faster growth and more predictability in their businesses. As a CFO, Brooke looks at every part of the business that touches the money, and that's the whole business. This eventually led her to becoming a U.S. implementer. Brooke helps firms gain clarity on their vision, discipline, and accountability to increase traction and develop a healthy and functional leadership team. I also know beyond that Brooke specifically helps folks focus on building that, not only doing those things for current success and cash flow, but also to build enterprise value. And she, unlike some CFOs and others, I'm not saying she's not the only one, but she certainly has this view of how to prepare a company for exit, not only on the numbers, but also where the gaps. And I have personally experienced Brooks in a couple of contexts. One is at a neo lawyers group where she came in and did a phenomenal workshop. And then at listeners, you've heard me talk about the Deal Exchange conference that I ran for Entrepreneurs Organization in Austin, Texas, and also had the pleasure to bring in Brooke there, who gave a great talk that was very well received. So Brooke, I am so excited to have you on the podcast.
Thanks for having me, Corey.
So listen, we want to get into all of this stuff around deals and your background and the great stuff you do for clients and all that fun stuff. But before we do that, I want to take you back to maybe 8, 10, 12 years old. What did you want to be? Because even though it sounds like earlier in your career, you got into this with the family business, I'm guessing a CFO and EOS implementer and coach and consultant and advisor on exiting businesses probably wasn't it when you were that young, but you tell me what it was.
Actually, interestingly, I was all about finance kind of at that age. So I grew up in Fort Worth, and Fort Worth has a very active investor community. One of my best friend's fathers had basically greenmailed Disney. He was the man that decided that Michael Eisner was going to be president of the company.
Wow.
Put him installed him the CEO after one 15-minute conversation. And he had all these really cute guys that worked for him. So when I'm 12 and 14, all these cute blonde guys from Wharton, I totally wanted to be in finance, right? And so that was my path. Absolutely. Wharton, that was the only thing I wanted to do. And if Richard Rainwater would take me, I was going to go work for him.
I love it.
I went to a high school that was really interesting.
Yeah.
We only went to class 4 days a week.
Okay.
And on the fifth day, we got to work somewhere.
Wow. In high school?
In high school.
Wow.
And I worked for Drexel Burnham.
Okay.
In the fall of 1987.
Okay. So I was at a law firm that represented Drexel Burnham as a summer associate at 84, starting as a lawyer at 85 through around that time. Yeah. 87 was when, things got interesting.
Interesting times, weren't they?
Yeah.
And I was in DC, the head of the DC office said, I went to him and said, will you write me a recommendation for Penn? Because I was being recruited to play squash for him. And he said, what's your plan? And I told him my plan. And he said, you will never be anything more than a glorified secretary here.
Wow.
And he said it truly out of all kindness.
Yeah.
I don't want to do this. And so I'm like, I'm not the type that wants to break through the glass ceiling. I threw my whole plan out the window and graduated from college, had no idea what I wanted to do, and ended up in retail for 15 years, 10 years.
Wow.
And I went back to grad school much later. And what's so funny is that I ended up back in the financial world, which is where I wanted to start when I was 8 or 10. But I definitely took the long path here.
That's wild. It's interesting because asking this question I don't know, 320 episodes. It's always interesting to see that it's pretty much never a straight line. For a lot of people, obviously, at that age, they haven't even thought about what they want to be in. But it's interesting, even the few people who had an idea of where they wanted to be, it's usually not, oh, and then I went into that and I've been doing that ever since and there's been no deviation from it. Like, it's just not, it's not the way life works. So I love that. What was the first deal you could think of that you did or you were involved in at any point in your, career early on or whatever comes to mind, the first deal of any type?
I think it was probably a deal. I was the receiver for a company. There was a divorce. There was a family-owned company. I ended up as the receiver. It was not going into bankruptcy,
Mhm.
but the husband and wife could not agree on anything. And so the court appointed me, and I basically had to run the company. And I had to divide it equally between the two of them. So I had to figure out how to take the one company and divide it into two, like, really functional, freestanding companies.
Right. This is not dividing up assets of a company that you're just liquidating, which is math. This is actually creating two operating companies.
Two separate operating entities out of one. Oh, and by the way, the value had to be the same.
Yeah, sure. Yeah. Yeah.
And I did it. I figured it out.
Wow.
I presented it to the court. And what I learned that day is that anger and spite will override logic every single day.
Yes.
And that couple took that company and basically did everything they could, went around me every way they could, and ran it into the ground, even though I was the receiver.
Wow.
And I'm like, you just threw millions of dollars away.
Yeah.
What else to spite your spouse?
Yes. Boy, it's amazing. I mean, and family, unfortunately, I've seen it with parents and children, with brothers, and sisters, siblings, with where they can't. I mean, we've had a couple recently, and we do some of this corporate divorce, as they call it, work. And yeah, it's one of the most challenging things as any kind of advisor is when logic does not prevail.
There was one, I was involved in one corporate divorce, and this was hysterical. The wife of one of the partners had put a piece of furniture in their office, and then they had built the doors on. So they didn't think they could get this piece of furniture out. And she was bound and determined that the other partners weren't going to keep that piece of furniture. She said, if I had to go in there with an axe and hack it to pieces, oh my God, good God.
Oh my God. It's just any case. So we'll talk a little bit more generally about, CFO, about EOS, but you've gotten into this as part of what you do, this sort of, niche and some of the workshop we did with you, where there's really a focus of how folks can create enterprise value. Now, the interesting thing is, and we've said this, the context is that like everything you should do, if you're doing it right to create enterprise value, also as you run just a much better, more profitable company, even if you never exit, right? That's the interesting part. But before we get into the substance of it, how did you start focusing more on, on that aspect of it, right? Because there are folks that do some of the things you do where that's not as much of a focus. You do talks on it, you got a book, right? And stuff like that. So, which wasn't even mentioned specifically in your bio. So feel free to talk about it.
Yeah, it's because I've written 6 books, Corey.
Yeah, exactly. You're not going to mention them all, right? So, but in terms of the stuff that relates to deals, like how did that become part of the focus of what you do?
It really became the focus because I do have a group of our clients that we work with is attorneys. We work with all kinds of companies, but we do also work, one of our specialties is law firms.
Yeah.
And lawyers, they're about to deregulate the legal industry, which means that non-attorneys can own law firms. It's already happened in 2 states in the District of Columbia. And I saw this coming. And I knew that deal activity was really going to pick up. It was going to pick up beforehand. And then, man, the second they open it up, it's just going to skyrocket. And this is a segment of the population that really hasn't ever done true deals. They've worked on their clients' deals, but
Sure.
they haven't sold their own businesses. And I got really interested in it. And what does it look like? And what are the levers we need to pull to make it profitable, to make it sale ready? And as I was writing the book, I was like, this is what we do with our clients as their CFO. Like, we do this and we do this and we do this. And I realized that the more you can optimize your company, the more you can make it less dependent on the owner, more profitable, have happy clients, happy employees, the better it is for your life now.
Yep.
And for your life in the future. And part of that is because not every industry has great exit multiples.
Right.
And legal's one of them. So
No question.
you got to make hay while the sun shines. So let's make it profitable now.
Yeah, it's really interesting. I have this ongoing, like, sort of joke, because we represent so many, again, similar to you. We have clients across industries. We do a lot, but we have this, one of our niches is in financial services, specifically with investment advisors. And I often say this to my client. I think I've mentioned it probably once or twice on the podcast, but is that we essentially do the same thing. I mean, not in terms of content, but in terms of relationship and level as our investment advisor clients. Like we represent successful people in sophisticated and important things in their life and business, right? To help them be more successful and grow, whether that's through deals or what we do, or contracts, whatever, whether that's through financial advice that financial advisors give and managing money and and planning and that kind of stuff. And so there's so many similarities there, but our investment advisor clients, especially now PE has come into that space and whatever, the multiples they're getting are crazy. Now, it's not just that PE, but there's a reason PE came in, and that is because they have recurring revenue because they're charging at a asset under management, a percentage of assets under management. It is recurring revenue. It is paid quarterly in advance. Okay, no receivables, automatically pulled out of a custodial account, right? I mean,
Yeah.
all the factors that, and of course, law firms don't have that. Most don't have recurring revenue. There's some exceptions. I mean, and to, make the distinction, I mean, obviously, listen, we've done very well. I'm not complaining. We have referral sources and clients where we consistently have money coming in, but it is on a, either hourly, fixed fee or project basis. It's not like the investment advisors that have X percent that comes in every quarter.
Right. I mean, you don't have clients that walk in and say, Corey, I am going to commit to you
Right.
and sign a contract guaranteeing
That's right.
that I'm going to do 4 deals a year at
That's right.
this level for the next 10 years.
That's right. And even some of the clients that are, that we have on some sort of monthly or quarterly retainer, recurring retainer, they can terminate us tomorrow. And in fact, ethically, as lawyers, we couldn't lock them in if we tried, right? So it's interesting because, in that segment, but there are so many other businesses because I know you got interested in this in terms of lawyers, but now, you do it across industries. There's so many other segments, like not everybody can be a subscription or recurring revenue business. It's just not, it'd be great, right? But not
Our SaaS companies love it.
Yeah, exactly. So what are some of the factors, like if you're, I mean, other than, great, I got it, if you can create recurring revenue, it's repeatable, the long-term contracts, that's great. But if you can't do that, like in law firms, like in a lot of consulting businesses, services businesses, non-SaaS, businesses, other even trades and stuff like that to do it by project, like what are some of the things that folks should be focusing on that will not only benefit them operating going forward, but also, help them create better opportunities for exit?
So I kind of look at it in different segments. And the first one's financial. I really believe after cost of goods sold, I'm not saying total revenue, but after cost of goods sold,
Yeah.
only about a third of your revenue should be going to payroll.
Mm-hmm.
And unless you're really growing aggressively, no more than 10% should be going to marketing.
Mm.
What are your multiples? How healthy are your financials? And can they be produced quickly? I had a client who, he was a great guy. And I picked him up actually sitting I was in an angel investing group here in Fort Worth. And he couldn't back up any of his numbers. And so they asked me if I want to invest. And I said, no, but here's my card. Tell him to call me. And so he did, but he was great at raising money and he had raised $7 or $10 million. And we were starting due diligence. And he's like, oh my God, they want all this information. Yeah, they basically wanted his P&L and his balance sheet and a couple other things. I was like, oh, honey, they haven't started yet. I can't tell you how many times I've been involved in deals where we've asked for the P&L
Yeah.
and they can't produce it for 2 weeks.
Yeah. Yeah.
Okay, that's a giant red flag. So, are your financials clean? Can you produce them quickly? At the end of the day, what percent of revenue is available to you as the owner to take home?
Yeah.
And then the question that I ask about everything that we look at, all of the 6 parts, is how much of your time as the owner does it take to turn the crank on financials? How much time are you spending collecting the money, sending out the bills, whatever else it is? Are you the one in QuickBooks? If so, that's a problem.
Yes. Yes. Yeah. And listen, you mentioned it earlier, one of the things is just how dependent in general is the business in various areas on the owner, right? And certainly, I got to tell you, listen, when I first started, I was the one in QuickBooks because I was the only one, right? But I would shoot myself at this point. Like I'm looking at financial reports that other people are producing for me, right, on a regular basis, right?
Right.
And God, billing, whatever. A lot of my listeners know I'm a big preacher of highest and best use. Only do stuff in the areas that you're great at, you're passionate about, and a high leverage make a big difference. And anything to do with finance other than looking at the reports and getting on, with our CFO service to talk about strategy and trends, like that's not my highest and best use, so.
It's not. Absolutely. So, yeah, you want your highest and best use. And what's interesting is that as most businesses grow,
Yep.
when you start a business, you wear every hat, right? You said you were the only one, so you were doing the books.
Yep.
Please God, your first hire needs to be a bookkeeper. I promise you, they are a lot cheaper and better at doing the books. I don't care what you do. And unless you are a bookkeeper and have a bookkeeping business, a bookkeeper is going to be better and cheaper than you are.
Yeah.
Most owners tend to spend most of their time in marketing, and they think that is their highest and best use. And yes, it is, until you get to the point where you're starting to think about selling and you realize how aligned is the name and the brand and the image of your company aligned with you.
Yeah.
It's really hard to find someone that looks exactly like you that has the same name, to sell your company to. It's hard to sell Brooke Inc.
Yeah.
And we went through about 2 years at my company, which was never named Brooke anything.
Yeah.
Because I knew not to do that. But we went through 2 years going, no, we can't do that. It's Brooke Inc.
Mm.
Got to get my image off of things. We have to get my voice out of it.
Yeah.
Because you can't sell that. And it's just going to lower the value.
Yeah.
And it means it's totally dependent on you to turn the crank.
Yeah. And it's really interesting to me because everything's in stages, right? So first of all, we went through this because as a lawyer up until I think about 2 years ago in New York, and in most states, some states went a little earlier, you actually you had a name after yourself. Like it was ethically, legally, you couldn't have a brand for a law firm. So they didn't even give you that option. And I would have named it something else from day one if it was legally permitted. And then, we had a challenge where by the time it was allowed, we had built so much brand equity in the Kupfer name, right, as a brand, right, that because in the beginning, actually, there is value in, the whole authority marketing approach to say, hey, get yourself out there as an authority, get known. There's a reason why you wrote 6 books, right? And Brooke wrote those books, not the company, right? And, but it's
So there was a discussion about whether I should write the books or whether the company should write the books. And the company almost wrote some of the books.
Well, and right. And going forward, what I'm saying is that I believe you got to look at this in stages. Like there's a time where it actually makes sense to create a profile for the leader of the company and the personal brand for that person and get known as an expert and all that kind of stuff, whatever, as a way to build initially, the marketing and that kind of stuff. Even if the company's not named after you, that you are the face of it. The thing is the ability to evolve that and phase it out over time well in advance of when you need to sell, because what got you here won't get you there. And, it's just so I want to be clear, like for the people who are earlier staged, I still believe in not naming after yourself if you don't have to from day one. I tell my investment advisor and other clients that from the beginning. And again, I would have done it differently if I had the legal option to do so.
You had the option. Yeah.
But I do believe that there's a time where it actually makes sense as a business proposition to build your personal brand, to have it, to get out there, to be the face of the company. It's just that if that continues, to well before sale, you got a problem.
Right. Well, let's look at a very famous brand. Let's look at Warren Buffett.
Mhm.
Everybody wonders what's going to happen when Warren Buffett is gone because he is so linked with Berkshire Hathaway.
Yep.
And there is discussion all the time about who the next person is and who's going to take over. And he's going to really need to bless that person and build their brand hugely before they take over. And God forbid he dies before he could get that done.
Right.
And
Right.
don't want to end up in a situation like that. Brilliant man.
Yep.
Incredible company.
Yep. And the interesting part on him as an example is, he had Charlie Munger, who's passed. And for a long time, at least, I think this is true, certainly true for me. Nobody knew about Charlie. And then there was a point at which like people, oh, wait, it's not just,
Right. There's a duo there.
yeah, there's a duo there. There's actually a duo there. It's just one of the, and you find that in some cases where you have the front facing person and the more behind the scenes person. And you don't, but obviously, I mean, Charlie was even older than, so, and he's gone now. So yeah, it'll be very interesting to see what happens in that situation with
Yeah.
Hathaway. Yeah.
So, there are things to think about in your marketing. Is it tied to you? Do you have a marketing plan? Are you tracking the metrics? So great, you've got a plan, but are you tracking the metrics? Can you update the plan? Do you know what's going on? And are your clients diversified? I had my first client ever. Awesome. Loved him. He was a great guy. 95% of his business came from one client. He didn't have a contract.
And you have a contract. Yeah.
There was no contract.
Yeah.
And I was panicked. I'm like, we've got to diversify. You can't put all your eggs in one basket.
Yeah. Yeah. And listen, obviously buyers are looking at concentration risk. And even valuation firms are going to give you a lower valuation if there's any significant concentration risk. And 95% is an extreme. Even if you have a client that's 30%, right?
You're going to ding you at 20. I really want to see it at 10 or below.
Yeah.
It's not until it gets down below 10 that I start to be like, okay, no one's more than 10%.
Yeah.
So we're really pretty good on that.
Yeah. So, it's interesting because I'm sure like a lot of, it's what I've always loved about you, Brooke, is that you have this clear view on where the numbers should be, but not just for the sake of the numbers, but how they affect these strategic abilities, the enterprise value, the ability to exit, whatever.
Yeah.
It's not just based upon some best practice ratio. It actually has a logic to it on how it's going to impact other things in the business going forward, including the ability to sell at the highest value.
Yeah. Let's face it. Your reports are nothing but they're a scorecard. They tell you how you did.
Right.
Not how you're going to do, but how you did. So they're just a starting point about where to investigate and which levers to pull.
Yeah.
And people are so surprised when they work with us that we're going in and we're looking at contracts and we're redoing comp plans and we're meeting with the marketing people and really looking at conversion rates. And then we're going and looking at production and saying, hold on, we can streamline this, we can do that, we can automate that. Like, whoa, you're a CFO.
Yeah.
Yeah, but that touches the money.
Yeah.
And we looked at this report and this number wasn't where we wanted it. So we started digging through the data.
Yeah.
And this is what we found. And so we know that we need to pull this lever.
Right. Yeah. And it's interesting. I mean, I'm sure I know a lot of our listeners understand what a EOS is, but it's not surprising to me based upon that just general outlook, philosophy, understanding, or whatever, that, at some point you said, oh, wait, in addition to this CFO service, right, I'm also going to be, an EOS implementer. So why don't you give people just a little bit on EOS and what that brings to the table? But just to preview in my mind, it's like, okay, so if you identify the numbers having a gap or being off or whatever, the question is going to be, okay, this is where you are, this is where you need to get to, right? How do we get there? And EOS is one of the one of the tools, right?
It's a great tool. Yeah. EOS has 6 pillars that it looks at. And you have to be strong in all 6 of these segments. And the idea is we want to be at least 80% strong.
Mm.
It's unrealistic to think that you're going to be perfect in everything. I mean, come on, Corey, no one's perfect. That's utopia. But if we could have a really strong vision that everyone in the company sees, if everyone can see the same destination, and that's amazing. If you can have, as Jim Collins says, the right people on the bus sitting in the right seats.
Yeah.
If we can get your people component really strong, and then if we can get your data component strong, which of course I love data. I'm a finance girl. I geek out on numbers, but are we looking at the right data? Are we looking at the data that gives us a pulse on the business, the 5 to 15 numbers that really tell us what's going to happen, not what has happened?
Yes.
And when you have those 3 components strong, you really have great visibility into the company. You can see everything that's going wrong. You can see all the problems, which is great because then you go in and fix them. But you can also really see all the opportunities.
Sure.
All of a sudden, all those great things you can do just kind of open up. The 4th component is the issues component. What are those problems we need to fix?
Yeah.
And how do we do it? And then process is the 5th one. How do we get things done on a consistent basis the same way every time? And I'm not talking about a 700-page SOP manual that's gathering dust on somebody's desk.
Yeah.
I'm talking about the 20% of the steps that get you 80% of the way there on the 20% of the procedures in the company to get 80% of the shit done. That's all it is. Yeah. And then the last one is traction. And this is really all about taking that vision and bringing it down to the ground and executing on that vision.
Yeah.
If everyone shares that vision, if we can get everybody rowing in the same direction, if we can create that accountability, then things really take off.
Yeah.
And what the reason why I got into this, someone gave me the book Traction, said it would be life-changing. I threw it in the backseat of my car and it lived there for 2.5 years.
Yeah.
No book is that amazing. I eventually read it because everyone in EO reads it. And, I got tired of people saying, what do you mean you haven't read it? Then it's good. So we self-implemented. And I didn't think a whole lot more about it until, as data-driven girls, because I do have a mostly female team, we started looking at our clients and we kind of divided them into 3 buckets. The clients that came to us and didn't seem to be making a lot of progress. The ones that were making steady progress. And then the ones that had that hockey stick, the high end to the right.
Yeah.
And we discovered the high end to the right with one exception. Every single one of them was running on EOS.
Wow.
And it was that traction. They all shared the same vision. They had the right people. They were looking at the right numbers, which, as CFO, we were really helping them do. They could identify the right issues and solve them once and for all. So just putting a Band-Aid on the problem. Yeah. They were getting their processes in place so everything happened the same way every time. And then everybody was rowing in the same direction. And they had created accountability. They were making decisions and executing.
In terms of your clients, in terms of, what are you seeing in terms of, exit deals and timing and the effects of various things that are going on? Are you seeing a trend in any direction in terms of more deals, less deals, higher valuations, people waiting? What's the sense that you're seeing in your client base and also just your ecosystem and beyond your client base? I know you're in this world.
Yeah, really, we're seeing a lot of people trying to get everything ready.
Yep.
I'm seeing deals pick up in certain places. Other places I'm seeing not so much.
Yeah.
I've got some people that I've talked to where I've got another attorney who does the same kind of work as you do. Their smaller deals have been really big this year. Their big deals, not quite as many. I don't know what you're seeing. Is that the same kind of thing?
Well, it's interesting for us. For us, it's a little more by sector in that so the investment advisor space is so hot and there's so much PE money that, any of the drags, whether it was, the concerns about the economy and inflation, the cost of capital, and we're recording today on November 7th is when we're recording this. The Fed just dropped interest rates another quarter of a point.
Yep.
After the half point drop previously. So, we'll see what the effect of that is. But so we've seen, like, in some segments, like our tech clients, we're seeing, except for AI and that kind of stuff, in some of the tech space, we're seeing a little bit of a slowdown at some of the other segments, but in financial services, both the small and the large deals, are going crazy just because that area is hot. PE money's coming in.
Yeah.
They're not really doing many deals off borrowed capital, so interest rates don't matter. PE's found the industry. They have a lot of powder to burn, and, and they're in favor of long-term trends. So we're seeing a distinction much more based upon sector than we are on deal size per se.
Yeah.
Yeah. Good. Yeah. So there's clients that are getting prepared, just like psychology wise, what, do you think they're waiting for interest rates to come down? Were they waiting for the election to be over one way or the other? Just, because listen, one of the things that's been shown is, uncertainty is not a good thing for deal flow, right? People want to know, especially on the bigger deals, professional deals. It's almost like people have preferences on what they want the landscape to be, but the bigger thing they want to know is what is the landscape, because they can adjust deal structure, size, blah, 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 valuations, whatever, to the landscape. Capital gains rates were higher. They adjust to that. It's the uncertainty because then they don't know how to adjust. So is that your sense on you folks that are preparing? Or were they waiting? What are they waiting to have in place that which would release some more deal flow for what you said?
A lot of the people we're working with aren't actually waiting on their exit for anything more than they're not ready.
Got it. Yeah.
They're not at the point where they're like, I'm still having too much fun.
Yeah.
There's no reason. And I think you and I have talked about this some. I've really looked at people who sell and big regrets.
Yeah.
And it kills me when people sell and have regrets. And now, of course, I can't remember the statistic. I should know it. It's something like, do you remember? It's like 80% of people who sell.
Yeah.
Like,
I forget this as well, but it's a really high percentage that have regrets. Now, those regrets can range from literal clinical depression to just some concerns. Again, hop in.
Yeah. All right. So it's a Price Waterhouse.
Yeah.
So 75% of those who exit profoundly regret.
Profoundly regret. Wow.
Profoundly regret. So, I want to stop that.
Yeah.
And one of the things that I found that is has been a theme running through the people who profoundly regret are the people who get bought out, who don't intend to sell, who get approached with a deal. They weren't looking for it. They weren't prepared for it.
Yes.
But they got a deal and it seems like a great deal. So yeah, why not?
Yeah.
Those people profoundly regret.
Yeah, that makes sense because also, if they're getting approached, there's a couple of things that happen when you get approached by a buyer and you haven't made a decision to sell and maybe work with a banker or a broker and run a process or whatever, because, then not only do you have options you're choosing, but even more so, like you made a decision, you're psychologically prepared, whatever. You get a buyer offer that's sort of too good to be true and you say yes. Not only have you not done all that pre-work, but they're going to be pushing the close because if they've approached you, they want the deal done. And by the way, they also don't want you to consider other options. So they're going to be in the speed to close mode. So, and then you're busy doing all the due diligence, providing the financials, like you said, all that work they have to do. So I think just elaborating on what you said, I don't think they ever get a chance to process it and really consider it and look at what they will do afterwards and how they'll feel about it. until after it's done, the money's in the bank and resume all saying good, but now it suddenly hits them like, okay,
Wait, maybe I should have shopped that deal.
yeah,
Maybe I could have gotten more. I talked to one guy not too long ago, and he said, I should have kept part of the company, sold 100%. And he said, they would have let me keep 10%, 20%. They probably would have let me keep a third.
yeah,
He said, but it was so rushed and it was such a deal and it seemed great. And he was 39 and it just seemed like an awesome opportunity.
yeah,
And the other thing that people regret is, when they go out and that they sell your company again and they make a ton of money and you're like, "Ugh, if I had just held on to it for 2 more years."
yeah.
But you're right. I think it's having the time to actually process everything.
Right. Which if, like you said, and listen, we see that somewhat in the financial services space because, I mean, I've had clients who, I had talked to a year or two ago and they were like, yeah, I think I got another 5, 7 years in this. I'm going to continue to build it, whatever. And then the multiples went so crazy the last few years because of PE that those same people have come back to me and said, yeah, Corey, I'm selling. Which investment banker should I work with? Or I have this offer or whatever it is. And I'm like, oh, I thought you were in another 5, 7 years. And they're like, well, you can't pass up the money, And I do have some of these conversations with them about, hey, are you sure? Have you thought about what you can do afterwards? But, there is a point, and I get it as as a financial decision, if multiples just sticking in the investment advisor space, they're, triple what they were, you know, 7, 8 years ago.
Mhm.
Right? We're not talking about an extra instead of getting a 7, times EBITDA, you're getting an 8. Like, what was a 7, you're getting 12s or 14s, now. So
Right.
what was a 3, you're getting 8.5. It's like, it's crazy.
Well, and you've got a great point. The people who said they had another 5 to 7 years in them, all of a sudden being like, "I'm done." That's why you wanna prepare to sell now
Yes.
so that you have that option. So, I've got a friend, he's a finance guy like you work with all the time, and he had that experience with his partners. He had another 5 to 7 years in him, and then something clicked, and he had kind of gone part-time,
Yeah.
but something clicked to the point where he went in the middle of the night and took down all of his awards and everything off of the wall. You know, that big award wall? Yeah. Of the, like, 40 some odd plaques that were up there, there was only one left after he took his, in the middle of the night. So, like, then he was ready to get out, and so everything had to be ready to go. And you need to be prepared for that because you do think you have another 5 to 7 years, that something might happen, or something might happen to you.
Yeah. Health issues.
God
All of it.
forbid, or,
Yeah.
So let's be prepared
Yeah.
and
Love it.
enjoy the fruits of our labor.
Before I ask you my final 2 questions, is there anything else, whether it's around, preparing for exit deals or just even about what you do and help clients that we haven't covered that you want to bring to the audience?
I think the biggest thing that we do, that I love that we do, is most people start their businesses because they have a passion for a product or a service.
Yeah.
They don't really go into it thinking, except for my cousin Robert, who wanted to buy a business. I'm like, what kind of business do you want, Robert? I don't care. Not usually what you find. By the way, he now makes skylights. I don't know.
Okay.
That was the business he found to buy.
Yeah.
Okay. But most people start because they've got a passion or for a product or a service. And most people don't have an MBA. They don't have that financial experience. And so the numbers part of it gets hard. And most companies can't afford to have a full-time CFO. And even if they can afford it, a full-time CFO would be bored because there's not enough to do.
Right.
And small businesses are the backbone of the American economy. And they're the ones that aren't getting that strategic advice.
Yeah.
And so I love helping those companies that are, like 2 to 30 million.
Yeah.
Get that strategic advice to help them grow and scale and be profitable and get whatever it is that they want out of their business.
Yeah.
Because they deserve the help just as much as Exxon does.
Love it. Love it. So if people want to find out more about your company, your services, your 6 books, where should they go?
The easiest place to go is brookelively.com.
There we go. BrookeLively.com. Brooke, my final question on the podcast is always about my highest value in life, which is freedom. And for me, that means everything from freedom around the world for all people from oppression to why I've been an entrepreneur for decades and haven't had a boss. What does freedom mean to you, and how does it impact your life and business?
When I started Cap, I wanted freedom. And so it's a virtual company.
Yeah.
It always has been. I actually have an office because I couldn't work in my house anymore, but I am the only one that ever goes into the office and no one is obligated to. That I wanted to work 4 days a week or 3 weeks a month.
Hmm.
Because I wanted that flexibility.
Yeah.
And when I went out to hire, I wanted to create that same kind of flexibility for my employees. A lot of the women I hired were women with children who had stopped working to raise their families.
Yeah.
Who had so much to offer.
Yeah.
That a 9-to-5 job, or let's be realistic, if you're doing CFO work, it's an 8-to-7 job.
Yeah.
And I wanted them to have that flexibility and that freedom, and they shouldn't have to miss a ballet recital or soccer practice or anything. And so our core values, our biggest one is all about living the integrated life.
Mm.
And it's however you define that, whatever your right mix is of work and non-work, and making it work for you. Are there people in my company who work at 11 o'clock at night because that's what works for them? Absolutely.
Yep.
And they may be taking a nap at 10 o'clock in the morning. I don't care.
Right.
They have that freedom. And I want everyone in my company to have that. And I want the clients we work with to have the same thing. I want the owners to have the freedom to spend their time doing what they love doing.
Yeah. Love it. Love it. Brooke, thanks for being such a great guest on the DealQuest podcast.
Well, thanks for having me, Corey. I loved it.